The number appears on the screen at 9:31 in the morning, and Marcus doesn't blink. He knew it was coming. In the abstract way a person knows the tide will rise. But knowing and seeing are two different acts of the mind, and the mind, for all its calculations, is still a body. His chest does the thing it does. His breath shortens by exactly one count. The red digit stares back at him. 17% down in a single session, a loss that took 11 months to build and 32 hours to erase. He does not sell. That is not the interesting part. The interesting part is what happens in the 11 seconds after he closes the laptop. That crystalline silence between seeing the number and deciding what it means. Because inside that silence, everything he thought he believed about money, risk, and his own judgment hangs suspended, waiting for him to decide if it is still true. Most people never learn how to invest, not for lack of information. Information has never been cheaper or more abundant, but because they are never taught the one thing that precedes every decision, how to think. How to separate what a price is from what a company is worth. How to remain rational when the crowd has become a single screaming organism. How to treat fear not as a signal to escape, but as data to examine. Benjamin Graham understood this in 1949 when the world was still rebuilding its confidence after a collapse that had taken 25 years to fully heal. What he wrote then, careful, precise, almost severe in its clarity, still holds. Not because markets haven't changed, but because human nature has not changed at all. This is a story about a man who had to lose money to understand what money really is. It is also, more quietly, a story about you, based on the book The Intelligent Investor by Benjamin Graham and adapted into narrative format to make its ideas practical and engaging. Chapter 1, The Invisible Disorder, or Why the Price on Your Screen is Not the Thing You Think It Is. Marcus Chen had a system. He had kept it in a spreadsheet since the age of 26, color-coded by sector, updated every Sunday night between 9 and 10, a ritual as reliable as his alarm. He was 38 now. The spreadsheet had grown from 12 rows to 411. He had, by his own conservative accounting, averaged a 9.3% annual return over 11 years. A number he was not shy about mentioning, though he usually found a way to let it emerge organically in conversation rather than announcing it outright. He lived in a 2-bedroom apartment in a mid-sized city, drove a car that was neither impressive nor embarrassing, and worked as a project manager for a logistics company where his reputation was built on exactly the quality his investments reflected, the appearance of control. He thought in systems. He trusted what he could quantify. He believed, with the quiet certainty of someone who has not yet been truly tested, that he was better at this than most people. He was not entirely wrong. He was also not nearly as right as he thought. The error was not in his spreadsheet. The error was in what the spreadsheet measured. It tracked prices. It tracked percentages. It tracked gains and losses with a precision that felt, in the moment of recording each week's numbers, like knowledge. But tracking what a stock price does and understanding what a business is worth are two different cognitive operations. And Marcus had spent 11 years believing they were the same thing. This is the first invisible disorder of the modern investor. The confusion between a number that changes every second and a value that takes years to reveal itself. The market is a machine that produces prices. It does not produce truths. It does not know what a company is actually worth any more than a room full of frightened people know how to evaluate structural engineering. The market is a collective emotional event, dressed in the language of rationality, and Marcus, like almost everyone who has ever sat in front of a trading screen, had mistaken the language for the thing itself. Benjamin Graham called this distinction the central intellectual task of investing, not central in the way that a professor calls something central to round out a syllabus. Central as in, if you miss this, you have missed everything, and all the analysis you perform around it is theater. The price is what you pay. The value is what you get. These two numbers are related. They travel together over long periods, pulled by the gravity of reality. But in the short run, they are as different from each other as a crowd's mood is from the weather it is reacting to. Marcus understood this intellectually. He had read the books. He had nodded at the right passages. He had typed notes into his phone during a podcast episode where a fund manager explained margin of safety with a diagram that he'd screenshot and never looked at again. The understanding sat in his mind the way a recipe sits in a drawer, technically accessible, practically unused. The morning the market dropped 17%, a correction triggered by a combination of interest rate signals, a geopolitical event in a region he could not have located on a map 3 months ago, and the particular kind of algorithmic herd behavior that modern markets now produce in concentrated bursts. Marcus discovered that knowing something and being prepared for something are not the same state of being. He had owned a position in a technology company that he believed was genuinely undervalued. He had done analysis, real analysis, not just chart reading, revenue growth, operating margins, debt to equity, the competitive moat of the product. He had constructed a thesis. The thesis was still valid. The company's fundamentals had not changed in 32 hours. The business was doing what it had been doing the week before, serving its customers, generating its revenue, compounding its retained earnings. Nothing about the underlying reality had shifted, but the price had fallen 19%, and the feeling that moved through Marcus's chest when he saw that number was not a rational response to a logical analysis. It was older than that. It was the same neurological signal his ancestors felt when they heard movement in tall grass. The sudden physical knowledge that something is very wrong, that safety is no longer guaranteed, that the correct response is to move. The body does not know the difference between a predator and a falling asset price. It responds to both the same way. Adrenaline, shortened breath, tunnel vision, the overwhelming desire to do something, anything, to restore the sensation of control. This is the second invisible disorder. Not the confusion between price and value, which is a cognitive error, correctable with the right framework. This is deeper. This is the physiological corruption of rational decision-making at the exact moment rational decision-making is most required. The market drops, and the body sounds an alarm, and the alarm says, sell, escape, get safe. And the alarm is wrong. Not always. Sometimes companies really do deteriorate. Sometimes a falling price is an accurate signal of declining value, and knowing the difference requires exactly the analytical capacity that the adrenaline response is specifically designed to suppress. Graham watched this happen to people for decades. He watched it happen in 1929. He watched it happen again in 1937. He watched educated, sophisticated people who understood the language of finance and could discuss yield spreads at dinner, make decisions under emotional distress that they would have recognized as irrational under any other conditions. And he came to a conclusion that sounded simple and was anything but. The investor's chief problem and his worst enemy is likely to be himself. Not the market, not the economy, not the Federal Reserve or the geopolitical landscape or the unpredictable behavior of sectors in transition. Himself. The instrument of his own analysis is the same instrument being corrupted by the emotional conditions the market creates. The surgeon cannot operate on his own heart. The investor cannot fully separate himself from the fear his portfolio generates. This is not a character flaw. It is a design specification. Marcus closed the laptop. He made coffee. He stood at his kitchen window for what turned out to be almost 20 minutes, watching the neighborhood below perform its ordinary morning rituals. A man walking a dog that was too large for the leash, a woman in scrubs moving quickly toward a car, 2 children on the corner ignoring each other while looking at their phones. And he noticed something. The world outside the screen was completely indifferent to the number on the screen. This sounds obvious. It was to Mark at that moment a small revelation. The company he owned a piece of still had its offices, its employees, its customers, its products. The value of those things had not changed because the price that humans were momentarily willing to pay for a share of ownership had changed. The earth didn't tilt. The coffee didn't taste different. The dog was still too large for the leash, and yet something in his chest was treating the number on the screen as though were the most important fact in the world, as though the entire structure of his life was somehow contingent on what strangers were willing to pay for a fractional share of a company whose products he used and believed in. He thought about something he had read years ago and stored in the back part of his mind where things go when they are not yet needed. Graham's parable of Mr. Market. This strange, bipolar imaginary partner who arrives every morning with a new price, a new mood, a new level of enthusiasm or despair, and offers to buy your share of the business or sell you his. Some days Mr. Market is euphoric. He has been reading the news and feels certain that tomorrow will be better than today, and he names a price that makes your share seem extraordinarily valuable. Other days exactly like this one, Mr. Market is convinced that catastrophe is imminent, that the company is less valuable than yesterday, that anyone with sense should sell immediately, and he offers to buy your share at a price that reflects his panic. The question Graham asked, the only question that matters in response to Mr. Market, is whether you have done your own analysis, whether you have your own estimate of what the business is worth. Because if you have done that work, then Mr. Market's daily mood becomes irrelevant. His panic is your opportunity. His euphoria is your warning. He is not your advisor. He is your mechanism. You use him when it serves you. You ignore him when it doesn't. But this requires something that is genuinely difficult. Not technically difficult. Not the kind of difficult that can be resolved with more information or a better algorithm. It requires the emotional architecture to hold your own judgment steady when the collective judgment of the market is screaming at you that you are wrong. And the market has a very compelling case for its own authority. It is made of millions of people, all with access to information, all with money on the line, all actively expressing their beliefs through their transactions. Who are you to say they're wrong? This is the third invisible disorder, and it is the most insidious of the three. The first is cognitive, the confusion of price and value. The second is physiological, the corruption of analysis by fear. The third is social. The market is not just a price machine. It is a social phenomenon, and social phenomena carry a particular psychological gravity. When everyone around you is treating a falling price as catastrophic news, the act of staying calm requires not just intellectual discipline, but a kind of social courage. The willingness to be wrong in the eyes of the group, which human beings are specifically wired to find deeply uncomfortable. Studies in behavioral finance, a field that did not exist when Graham was writing, but that has since confirmed everything he intuited, have repeatedly demonstrated that people make worse investment decisions in groups than alone, that watching someone else panic accelerates the panic response, that the presence of social consensus around a belief, even a clearly irrational belief, makes that belief psychologically harder to resist. The crowd is not wisdom. The crowd is a weather system. And Marcus, standing at his window with the coffee getting cold in his hand, was trying to figure out how to stop treating the weather as truth. He didn't sell, not because he had summoned some heroic reserve of rationality. He didn't sell because he was, in that moment, frozen, stuck between the alarm going off in his body and the analytical part of his brain that was slowly, effortfully reassembling its argument. He didn't sell because he couldn't yet move, and sometimes not moving is the correct action even when the decision to not move is made for the wrong reasons. Later, he would understand this as the beginning of an education. Not a formal one, no course, no credential, no professor standing at a board. An education conducted by reality, using money as the tuition and attention as the prerequisite. The kind of education that only becomes possible when something you thought you understood turns out to be something you had only memorized. Graham spent his career trying to give investors a tool that would protect them from themselves without requiring them to become different people. He was not naive about human psychology. He had watched it fail spectacularly under conditions of extreme market movement. He knew that the fear response was not eliminable. It is not a software bug that can be patched. It is a feature of the operating system. What he tried to provide was a framework so sturdy that it could function as a counterweight to the emotional weather. A set of principles that, if applied consistently and honestly, would make it possible to act rationally even when feeling irrational. The framework begins with a single distinction that, once genuinely understood, reorganizes everything else. Investment versus speculation. Not 2 points on a spectrum. Fundamentally different activities that only look similar because they both involve buying things in financial markets. Investment, as Graham defined it precisely, involves thorough analysis, promise of safety of principal, and adequate return. Anything that doesn't satisfy all three conditions is speculation. Not gambling necessarily. Speculation can be profitable. But speculation, which means you are betting on a price movement rather than owning a piece of a business. Most people who believe they are investing are speculating. They are buying because the price went up, or because someone told them it would go up, or because the chart looks like charts that went up before, or because the sector is hot, or because they are afraid of missing the move. These are not investment theses. They are crowd behaviors dressed in financial language, and the difference matters not because speculation is immoral. Graham was not a moralist, but because speculation and investment require completely different psychological profiles and completely different decision-making frameworks, and confusing them is like confusing sailing with swimming. Both activities involve water, and one of them will drown you if you approach it with the other's preparation. Marcus had been speculating while believing he was investing. His spreadsheet tracked prices, and he had been making decisions based on price movements while telling himself a story about fundamentals. The thesis he had constructed for the technology company, the revenue growth, the operating margins, the competitive moat, was real analysis. But it had existed alongside an emotional relationship to the price that was pure speculation. The satisfaction when the price rose, the anxiety when it fell, the sense that the daily movement of the number was telling him something important about whether his thesis was correct. It was not. The daily movement of the price was telling him what strangers were currently feeling. That is a different category of information. This is what Graham meant when he wrote. With a precision that sounds almost clinical but is actually profoundly merciful, that the investor's attention should be directed not to the market's opinion of value, but to the investor's own estimate of value. His own estimate, independently arrived at, defensible on its own terms, without reference to what the market currently believes. Because if your thesis depends on the market validating it within a time frame that is comfortable for your nervous system, it is not a thesis. It is a hope. Investment, true investment, requires the capacity to hold a position while the market disagrees with you. Not indefinitely, not blindly, not without the willingness to revise your thesis if actual evidence of deterioration emerges, but the ability to distinguish between evidence of deterioration and evidence of temporary price decline is itself the entire game, and that ability lives in the analyst's judgment, not in the market's signal. Marcus would spend the next several months learning this not as a concept but as a practice. He would learn what it felt like to hold a position through disagreement, and then watch the thesis prove out. He would also learn what it felt like to hold a position through disagreement, and then watch the thesis fail, to distinguish between a Mr. Market who was panicking unnecessarily and a Mr. Market who was, for once, seeing something real before he did. Both experiences are part of the education. Neither is comfortable. Both are required. But that comes later. For now, on a Tuesday morning, the coffee is cold, and the dog with the too large leash has disappeared around a corner, and Marcus is standing at a window, trying to remember what he actually believes about the company he owns. Not what the screen said. Not what the financial Twitter accounts are saying. Not what the market is pricing. What he believes, based on what he studied, about what this business is actually worth. It takes him a few minutes. The answer, when it comes, is quieter than he expected. He still believes the thesis. The fundamentals have not changed. The price has changed, and the change in price has created an opportunity to buy more at a discount, or to hold and wait for the market's mood to realign with the business's reality, or to sell if he decides the thesis was wrong from the start. But not to sell because the number on the screen is red and his chest is doing the thing it does. He opens the laptop. The number is still there. It is, if anything, slightly worse. He does not sell. This is not the triumph of rationality over emotion. It is something more complicated and more interesting than that. It is the first moment in 11 years of active investing that Marcus has acted from a position rather than from a price. The distinction is invisible to anyone watching. The spreadsheet will record it as simply another week's data. But something has shifted in the way he is thinking about what he is doing, and shifts like this, small, interior, almost imperceptible, are the only kind that last. Graham's great insight was not technical. It was psychological. He understood that the market, for all its complexity, ultimately punishes one thing above everything else: the absence of a framework. Because without a framework, you are left with feeling, and feeling will betray you at the worst possible time with terrible consistency. With a framework, a genuine, internalized, honestly tested framework, you still feel, but the feeling becomes one input among several rather than the only voice in the room. The framework takes time to build. It requires reading, and more importantly, it requires application, the specific, uncomfortable experience of holding a belief about value while the market expresses a different belief about price, and watching what happens. It requires being wrong enough times that you understand your own error patterns. It requires a kind of intellectual honesty that is particularly difficult in an environment that rewards confidence and punishes ambiguity, where admitting you don't know something feels like weakness rather than the first step toward knowing it. But the alternative, continuing to mistake motion for knowledge, price for value, the market's mood for your own judgment, is not a neutral position. It is an expensive one. Not always immediately. Markets can be generous to the underprepared for stretches long enough to feel like validation. But the reckoning comes. Graham knew this. He had seen it happen to brilliant people with sophisticated vocabularies and complete access to information. The technical knowledge had not saved them because the failure was never technical. It was always, in the end, a question of what you do in the 11 seconds between seeing the number and deciding what it means. Marcus closed the laptop again. This time he made fresh coffee. Outside, the neighborhood continued its ordinary morning. The world remained indifferent to the screen. And somewhere inside the machinery of the market, Mr. Market was already composing his offer for tomorrow. A different price, a different mood, a different invitation to confuse the temperature of human emotion with the permanent fact of what things are actually worth. The only protection against him, Graham had written, was to know your own mind before you ever looked at his number, to have done the work, made the estimate, constructed the case, and arrived at a value that belonged to you, not to the crowd, not to the algorithm, not to the current news cycle, before the offer appeared. Marcus had 11 years of practice behind him, and a thesis in front of him, and a morning that had clarified something that no amount of reading had yet managed to make fully real. He had felt the difference between knowing a principle and needing a principle. He had stood in the gap between them, and the gap, he now understood, was the entire distance between an investor and a speculator. One knows what the business is worth. The other knows what the market is feeling. Both of them are watching the same screen. Only one of them is seeing the same thing twice. There is a concept that appears in the literature of cognitive psychology but deserves a permanent home in the vocabulary of any person who has ever owned an investment. Emotional anchoring. The idea is straightforward and devastating in equal measure. When you first see a price, the price at which you bought something, the price at which it peaked, the price at which you almost sold, that number becomes an anchor in the mind. It lodges. It sets a reference point against which all subsequent prices are unconsciously evaluated. A stock that you bought at $40 and which is now trading at $32 does not feel like a stock worth $32. It feels like a stock that is $8 in the red. The emotional weight of that $8 gap is not informational. It has nothing to do with the current value of the company. The company does not know you paid $40. The market does not care. But your nervous system does, and it colors every subsequent decision you make about that position with the ghost of a price that is no longer even available to you. Graham understood anchoring before the psychologists had named it. He saw it operate on investors of every level of sophistication, the novice who refused to sell at a loss because selling would transform an unrealized pain into a realized one, and the professional who held a deteriorating position well past the point of sense because his reputation was now tied to the original thesis. The anchor is no respecter of intelligence or experience. It embeds itself in the mind through the simple mechanism of attention. Whatever you paid close attention to becomes reference, and reference distorts perception. The antidote is not detachment. Graham did not counsel investors to stop caring. What he counseled was a prior commitment. The decision about what to do at a given price should be made before that price appears. Not in the moment of its appearance, when the anchor is already set and the fear or greed has already begun to operate. Before, when the mind is clear, when the portfolio is merely a collection of analytical positions rather than an active source of emotional stimulus, when the question of what to do in a down scenario is a theoretical exercise rather than a survival one. Marcus had never asked himself that question before entering a position. He had analyzed the upside, the thesis, the potential appreciation, the timeline he imagined, without ever constructing a serious answer to the downside scenario. This is not unusual. Optimism is cognitively easier than contingency planning. The brain is far more willing to elaborate the pleasant future than to prepare for the difficult one. But investing without a prepared response to adverse price movement is like driving on a highway without having thought through what you would do if someone cut you off. The emergency happens and you improvise, and improvisation under pressure is simply fear given a steering wheel. He would make himself answer the question now. What does a 20% drop in this position actually mean for the thesis? Not for the price, for the thesis, for the underlying reality of the business, for the competitive position, for the earnings trajectory, for the specific conditions that led him to believe the company was worth more than the market was pricing it. If those conditions are unchanged, the drop in price is irrelevant to the investment decision and potentially relevant as an opportunity. If those conditions have deteriorated, if the revenue has contracted, if a competitor has entered the market, if management has made decisions that compromise the moat, then the thesis is wrong and the price, rather than being a villain, is actually the messenger of a truth he would prefer not to hear. This is the real work, not the spreadsheet, not the charting, not the tracking of sector rotations or the reading of earnings call transcripts in the hope of catching a signal before the market does. The real work is the honest, uncomfortable, ego-resistant evaluation of whether what you believed about a company is still true, and the willingness to act on that evaluation, rather than on the feeling that the price generates in your chest. Graham called the investor, who could do this consistently, a defensive investor. Not in the sense of someone who plays it safe, but in the sense of someone who has built defenses against the most reliable threat to their own success. The threat is not the market. The market is just weather. The threat is the reaction to the weather, the decision made in the 11 seconds of noise and adrenaline when clarity is at its lowest and the stakes feel at their highest. Marcus would sit with this for a long time. The concept would unsettle him in the way that genuinely useful ideas always do, not because it was new, but because it reframed what he had already done in a light that was not entirely flattering. He had not been an investor. He had been a sophisticated speculator with a narrative about fundamentals. The narrative had been mostly accurate, which is the most dangerous kind of wrong. Wrong enough to miss the deeper truth, accurate enough to avoid the consequences that would have forced correction. He poured the second coffee and stood at the window again. The neighborhood was quieter now. The morning rush had passed, and a particular stillness had settled over the street. The kind of mid-morning quiet that belongs to people who are elsewhere, at their work or their appointments, while the city exhales between efforts. He thought about what it would mean to actually do this differently. Not to read about doing it differently. He had read about it. Not to nod at the principle. He had nodded at it many times. To actually structure his practice around the idea that a price is not a verdict, that a falling number is not a judgment, that the market's current opinion of his thesis is information to be examined rather than pressure to be obeyed. It would require, he realized, something that no book had yet quite named directly, but that all the books he had read were circling, a stable identity as an investor that existed independent of the market's opinion of him. Not arrogance. Arrogance closes the mind to evidence. But a grounded sense of what he believed and why he believed it that did not collapse when the price went the other direction. A self that was not defined by the number on the screen. Graham had this. You can feel it in the writing. A quality of unagitated certainty, the kind that comes not from predicting correctly, but from having been wrong. Often enough that you understand exactly where the limits of your knowledge are, and have made peace with those limits. He was not a man who needed the market to confirm his analysis. He was a man who had done his analysis, stated his case, named his price, and then waited with the patience of someone who understood that time is on the side of the person who knows what something is worth. The coffee was still warm. The number on the screen was still there. Marcus had not solved anything, but something in his relationship to the screen had shifted. Not eliminated, not resolved, but shifted. And shifts are where education begins, in the gap between what you thought you knew and what you are just now starting to understand. Chapter 2. The Weighing Machine, or what the market actually is, and how it is not what you think. 3 weeks after the drop, Marcus did something he had never done before in 11 years of active investing. He went back to the beginning, not to the beginning of his spreadsheet, not to the first position he had ever opened, but further back than that, to the question he had never actually answered with any rigor. What is this activity exactly that I have been doing? What are the rules of it? Not the mechanical rules, not the tax treatment of long-term capital gains versus short-term, not the mechanics of how a limit order works. The philosophical rules, the rules that determine whether a decision, in retrospect, was rational regardless of whether it produced a profit. He found Graham on a Tuesday afternoon in a used bookstore 3 blocks from his apartment, the kind of place that smells of paper and quiet and the accumulated decisions of people who had, at various points in their lives, believed that books were worth keeping, and then later believed otherwise. The copy he found was not a first edition. It was not even a particularly clean copy. Someone had underlined passages in blue ballpoint, and the underlining was inconsistent. Heavy through the first 2 chapters, lighter, and then absent through the middle, then resuming with fresh intensity near the end, as though the previous reader had put it down and picked it up again months later, or had read it the first time without understanding it and returned to it when something in their life had made the understanding suddenly necessary. Marcus bought it for $4. He read it the way he had not read anything since graduate school. Slowly, with a pen, treating each paragraph as something that required his full attention rather than his scanning speed. He had grown used to consuming information at the pace the internet demands. Headlines, summaries, podcast episodes played at 1.5 speed, threads that compressed a book's argument into 12 numbered observations that could be absorbed while waiting for coffee. Graham could not be read this way. The sentences were too precise. They had been written by someone who considered each word as a unit of argument, not decoration, and reading them fast was like reading a contract fast. Technically possible, practically dangerous. What emerged from the slow reading was not a set of techniques. It was a structure, a way of organizing the relationship between an investor, a business, and a market that, once seen, made the previous 11 years look less like a career and more like an extended improvisation. Competent in stretches, lucky in others, never quite resting on a foundation that could bear the full weight of a genuine test. The structure had a name, or rather, it had a metaphor at its center, and the metaphor was this: the market is not a scale. A scale measures what something weighs and tells you the truth. The market is a voting machine in the short run and a weighing machine in the long run. And the entire art of intelligent investing consists of knowing which machine you are dealing with at any given moment and positioning yourself accordingly. This was not Graham's original formulation. He attributed it to his teacher, who had arrived at this distinction through decades of watching intelligent people make terrible decisions because they could not separate the crowd's current opinion of a company from the company's actual economic reality. The metaphor had survived because it was true in the specific way that good metaphors are true. It named something real that had previously existed only as a vague intuition, and by naming it, it made the thing manageable. Marcus read the sentence 4 times. Then he wrote it in the margin of the book, because the book's previous owner had not underlined it, which seemed like an oversight worth correcting. The market is a voting machine in the short run and a weighing machine in the long run. He turned the phrase over in his mind the way you turn a key in your hand before putting it in a lock, feeling the shape of it, testing its weight, understanding intuitively before you have to commit to the insertion that this is either the right key or it isn't. It was the right key. Here is what it unlocked. For 11 years, Marcus had been watching the voting machine and believing it was the weighing machine. He had tracked prices, daily, weekly, the Sunday ritual with the spreadsheet, and he had treated the movement of prices as information about the underlying reality of the companies he owned. A rising price meant the market agreed with his thesis. A falling price meant the market was questioning it. His emotional state had been calibrated to the voting machine's daily output, which meant his emotional state had been calibrated to the aggregated mood of millions of people, none of whom had any special obligation to be right, many of whom were operating under exactly the same fear and hope and cognitive distortions that he was. The voting machine records opinions. The opinions are sincere. The people casting them believe what they believe, and their beliefs are informed by real information. Earnings reports, economic data, competitive intelligence, analyst forecasts. But beliefs are not valuations. A belief about a stock can be updated in an afternoon by a news cycle. A genuine, fundamental valuation of what a business is worth, based on the cash flows it will generate over its lifetime, is almost impossible to update meaningfully in an afternoon, because businesses do not change that quickly. Their fundamentals are sticky. Their competitive positions are durable. Their earnings power is established over years, not hours. The gap between these two timescales is where the intelligent investor operates. Graham called it the margin of safety, and the term has been repeated so many times in financial literature that it has acquired the comfortable vagueness of a phrase everyone knows, and no one quite interrogates. Marcus had used the phrase himself. He had not fully understood what it named. Margin of safety is not caution. It is not risk aversion in the way that term is commonly used. It is something more precise and more powerful. It is the quantitative gap between what you estimate a business is worth and what you are paying to own it. If you believe a company is worth $100 per share and you buy it at $60, you have a $40 margin of safety. That margin is not primarily about protecting you against loss, though it does that. It is about acknowledging the fundamental uncertainty of any valuation exercise. No estimate of intrinsic value is perfect. Every projection involves assumptions that may prove wrong. The margin of safety is the cushion you build between your estimate and reality, the recognition that being off by 20% in your valuation should not cost you your principal. The larger the gap between price and estimated value, the larger the safety margin, and the more errors you can absorb and still come out ahead. This is counterintuitive in a market environment where assets are often discussed in terms of momentum. Buy what is going up, avoid what is going down. Momentum investing builds no margin of safety. It relies on the voting machine to keep voting the same way tomorrow as it did today. The intelligent investor does something different. He allows the voting machine to create conditions that the weighing machine will eventually correct, and he positions himself on the right side of that correction before it happens. Saka spent a Sunday afternoon working through a valuation exercise on the technology company he had held through the drop. He had done valuation analysis before, discounted cash flow models, comparable company analyses, the standard toolkit of anyone who has read the right books. But he had done them, he now understood, as justifications rather than as genuine inquiries. He had built a model that confirmed the price he had already decided he was willing to pay. The model had started from the stock price and worked backward to a set of assumptions that made the investment look reasonable, rather than starting from the company's fundamentals and arriving independently at a value that could then be compared to the price. This is a subtle but catastrophic inversion. It is the difference between a doctor who examines a patient and reaches a diagnosis versus a doctor who decides the diagnosis in advance and interprets the examination accordingly. Both processes involve the same tools, the same information, the same vocabulary. The outputs are completely different in quality and in reliability. The first process is designed to discover truth. The second is designed to confirm a prior belief while maintaining the appearance of rigor. He started the model over. He cleared the stock price from his mind, genuinely cleared it, wrote it on a piece of paper, and put the paper in a drawer so he could refer to it later, but could not see it while he worked, and began from the company's financials. Revenue over the past 5 years, operating margins, capital expenditure requirements, the reinvestment needed to sustain growth, the competitive dynamics of the industry, the durability of the customer relationships, the barriers that prevented a well-capitalized competitor from replicating the core product in 18 months. 3 hours later, he had a number. It was not a precise number. No valuation is, but it was a range between $78 and $94 per share, depending on which set of growth assumptions proved closer to correct. The stock was currently trading at 51. He looked at the paper in the drawer. Before the drop, it had been trading at 63. At 63, there had been a margin of safety of roughly 15 to 30%, depending on where in the range reality ultimately settled. At 51, the margin had expanded to between 34 and 46%. The drop had not made the company worth less. It had made it possible to own a piece of it at a substantially more favorable price. The voting machine had panicked. The weighing machine had not moved. This was not a comfortable realization. It carried with it an implication that Marcus was not entirely prepared for, that the discomfort he had felt during the drop, the constriction in his chest, the impulse to sell, the sense of being wrong, had been the appropriate emotional response to watching a price fall and a completely inappropriate guide to investment decision-making. His feelings had been accurate. They had accurately represented what he was experiencing. They had been useless, worse than useless, actively misleading, as tools for evaluating what he should do. Graham had a name for the kind of investor who confuses these two things. He called him the speculative investor, as distinct from the defensive investor and the enterprising investor. The speculative investor is not a villain in Graham's taxonomy. He is simply someone who has not made the distinction, who is making decisions based on price movement rather than value assessment, and who will therefore have results that track the market's mood rather than the underlying economic reality of the businesses he holds. The defensive investor, in Graham's framework, has a more modest ambition but a more reliable outcome. He constructs a portfolio of high-quality businesses bought at reasonable prices, maintains a discipline about not overpaying, and then does very little. He resists the temptation to optimize constantly. He accepts that he will not capture every gain and miss every loss. He trades the excitement of active management for the quiet compounding of a portfolio that is fundamentally sound and never bought at a price that requires everything to go right for the investment to succeed. The enterprising investor goes further. He seeks situations where the gap between price and value is wide enough to generate returns substantially above what a passive approach would deliver. He is looking for companies that the voting machine has temporarily mispriced, where the weighing machine will eventually reassert itself, where he can buy at 60 what is worth 100 in weight. This category requires more work, more patience, and more willingness to hold positions that the crowd finds uncomfortable. What both the defensive and the enterprising investor share, and what separates them from the speculator, is the primacy of value over price. The price is the input, the value is the anchor. The gap between them is the opportunity or the warning. The opportunity if the price is below the value, the warning if it is above. Everything else, the news cycle, the analyst upgrades and downgrades, the quarterly earnings surprises, the macroeconomic commentary, is noise in the signal, relevant only insofar as it affects the actual long-term economics of the business. Marcus began reading the quarterly earnings reports of the companies in his portfolio differently. Not as news, not as events that told him whether the price would go up or down in the next session, but as data points in an ongoing assessment of whether his estimates of intrinsic value needed to be revised. The revenue number was not good or bad in itself. It was good or bad relative to the trajectory he had projected, and the implications of any divergence were about the long-term earnings power of the business, not about what tomorrow's price would do. This was harder than it sounds. The financial media is structurally organized around the voting machine. Every earnings announcement is framed in terms of whether the company beat or missed the analyst consensus estimate, a number that itself represents the aggregated opinion of people who are, by profession, trying to predict what the voting machine will do, rather than what the weighing machine will eventually say. A company that beats the consensus estimate by 2 cents is described as having delivered a strong quarter. A company that misses by 2 cents is described as having disappointed. Neither description has any necessary relationship to whether the company's long-term earnings power has improved or deteriorated. Graham spent years documenting how this short-term framing corrupts investment decision-making. He had data from decades of market history showing that the companies most favored by the voting machine, the ones with the highest price-to-earnings ratios, the ones that had been consistently beating estimates, the ones that the financial press was most enthusiastic about, systematically underperformed their less glamorous counterparts over long holding periods. Not because the popular companies were bad companies, because they had been bought at prices that left no room for the weighing machine to deliver a positive surprise. All the optimism was already in the price. The unpopular companies, the ones the voting machine had dismissed, the ones that had missed estimates, the ones that were in unglamorous industries or had recently navigated some difficulty, often contained the most attractive opportunities for the investor, who could evaluate them on their fundamental merits, rather than their current standing in the popularity contest. Marcus looked at his portfolio with this lens for the first time. What he saw was that his holdings, which he had believed represented a diversified collection of businesses he understood, were heavily weighted toward companies that were well-regarded, well-covered, and well-priced. He had been buying things the voting machine liked. He had been paying the voting machine's prices. He had built, without intending to, a portfolio that was fundamentally dependent on continued enthusiasm from a machine that had no loyalty to anyone and changed its mind on a daily basis. There is a specific kind of loneliness that comes with being an investor who has genuinely internalized the distinction between the voting machine and the weighing machine. It is not a painful loneliness. It is closer to the feeling of standing in a room where everyone is speaking a language you also speak, but can no longer quite take seriously, because you have seen what the language obscures. The financial media speaks the voting machine's language natively and fluently. Its entire architecture, the tickers scrolling at the bottom of the screen, the breathless commentary on each percentage point of daily movement, the guests who are asked whether the market is going up or down this week as though this were a coherent question with a meaningful answer, is built to serve the voting machine's audience, to help them understand what other voters are currently thinking, so they can vote more confidently themselves. The enterprising investor sits somewhere outside this conversation. He is not indifferent to the daily price. The daily price is where he transacts, where he buys when the margin of safety is adequate and sells when the price has reached or exceeded his estimate of value. But the daily price is a tool, not a verdict, and the financial media, which treats every price movement as a verdict, is not his primary source of information. His primary source is the financial statements of the companies he studies, the competitive dynamics of the industries he follows, the long-term economic history of sectors and cycles that gives context to whatever is happening today. Marcus began to build what he thought of as a second attention, a form of awareness that ran parallel to his ordinary day and was pointed not at the market's mood, but at the underlying economic reality of a small number of businesses he had chosen to understand deeply. He read annual reports the way Graham had recommended reading them, carefully, skeptically, with particular attention to the footnotes and the management discussion sections, where the decisions that would compound into future results were often embedded in language that rewarded the patient reader and punished the scanner. What he found, again and again, was that the businesses he thought he knew were more complex and more interesting than the stock price had suggested. The simplification that a price imposes, reducing an entire organization with its culture and its people and its competitive dynamics and its strategic decisions to a single number, is both necessary and dangerous. Necessary because a number allows comparison and transaction. Dangerous because the reduction is violent. It removes everything that makes the business a business and leaves only the mood of the current moment, expressed as dollars per share. Graham's framework returned the business to the center. It insisted that the investor's primary relationship was with the business, its economics, its durability, its capacity to generate cash and reinvest it productively, and that the market was merely the medium through which the investor accessed that relationship, not the source of information about its quality. This inversion, business first, market second, is the fundamental reorientation of the intelligent investor. It sounds simple. It requires a sustained, deliberate effort to maintain in an environment that is structured, at every level, to do the opposite. He found himself in those weeks returning to a word that Graham used with unusual frequency for a writer of such precision: temperament. Not intelligence, not analytical skill, not access to information or sophistication of method. Temperament, the capacity to maintain a stable relationship to your own judgment under conditions designed to destabilize it. The ability to hold a position when the market disagrees, to revise a position when evidence genuinely demands it, and to know the difference between those two situations, which requires not just analysis but self-knowledge, the uncomfortable kind that only accumulates through experience with your own errors. Graham had this temperament by disposition and had refined it through decades of practice under real market conditions, including the loss of nearly everything in 1929 and the patient rebuilding of both his portfolio and his philosophy in the years that followed. His writing carries the quality of someone who has been through the worst the market can produce and has emerged with his not just intact but clarified, tested against the most extreme conditions and found to hold. This is a different kind of authority than the authority of someone who has theorized from the outside. It is the authority of survived experience, and it has a distinctive weight. Reorienting a portfolio is not an afternoon's work. Graham was explicit about this. The process of moving from speculative to investment-oriented decision-making takes time, requires honesty about what you actually know versus what you believe, and involves the uncomfortable reckoning with past decisions that did not rest on the principles you are now adopting. You cannot simply declare yourself an investor and have it be so. The identity has to be built through practice, which means through decisions made under real conditions, with real money, in real time. But the framework was clear now in a way it had not been before, and framework is where everything begins. Without a framework, you are navigating by feeling, and feeling, as Marcus had discovered at 9:31 on a Tuesday morning 3 weeks ago, is a guide that deserts you at the exact moment you need it most. With a framework, a genuine, tested, honestly applied framework, you have something to return to when the feeling overwhelms. Not to suppress the feeling, not to pretend it isn't there, but to have a second voice in the room when the first one is screaming. He thought about the previous owner of the book. The inconsistent underlining, the initial intensity, and then the gap and then the return. He thought about what must have happened in that gap, the life that had been lived, the decisions that had been made, the reckoning that had eventually sent the person back to the pages they had initially underlined and then abandoned. He would never know the story. But he knew the shape of it, because it was also his shape, the knowledge received before it was needed, sitting dormant in the mind until the conditions arrived that made it suddenly, urgently necessary. The book sat on his desk now, open to a page near the middle where Graham had written, with the directness that characterized his best prose, that the investor's chief problem is not whether he can identify undervalued companies. Analytical tools for this purpose exist and are learnable. The chief problem is whether he can maintain the discipline of his method when the environment punishes that discipline in the short run. When the speculator is winning and the investor is waiting. When the voting machine is loud and the weighing machine is silent. When the crowd is certain and the analyst is uncertain, and the uncertainty is not a weakness, but the only honest acknowledgement of what investing in a business over time actually involves. You were not born an intelligent investor. You became one, if you became one at all, through the specific education that only the market could provide, and only if you showed up to that education willing to learn from it, rather than simply to survive it. The used bookstore was still open. When he walked past it on his way home that evening, he paused outside the window and looked at the stacks visible through the glass, the ordered disorder of accumulated knowledge, decades of human thinking, compressed into spines of various colors and thicknesses, waiting for the right person at the right moment. He had been the right person at the wrong moment for 11 years. He had read the right books and retained the vocabulary while bypassing the substance, because the substance only becomes accessible when you have been adequately prepared by failure. He walked home carrying the book, with its inconsistent underlinings and the margins full of his own notes, and he thought about the weighing machine moving in the dark, indifferent to the daily noise of the voting, pulling price slowly and inexorably back toward value in a process that took years and was invisible until it wasn't. And he felt, for the first time in 3 weeks, something that was not anxiety and was not false confidence, but was something rarer and more useful than either. The particular calm that comes from having found the ground beneath your feet. Chapter 3. The weight of uncertainty, or what happens when you are right and it keeps feeling like you are wrong. The ground does not stay where you find it. Marcus would learn this in the months that followed, and the learning would not be gentle. He had found the framework, he had internalized the metaphor. He had rebuilt his valuation from scratch and confirmed that the thesis held, and that the drop had been the voting machine misfiring, and not the weighing machine speaking. He had felt the particular calm of a man who has stopped improvising and started operating from principle. And then, in the specific and merciless way that markets have of testing every belief you hold about yourself, the conditions changed, not the market conditions. Not in any dramatic headline-generating way. What changed was the texture of the uncertainty, because the drop had been followed by a partial recovery, and the partial recovery had been followed by a plateau, and the plateau had stretched for 4 months, and 4 months of a portfolio going sideways, while the broader market moved upward by 11% is a very particular kind of pressure. It does not have the acute drama of a crash. It has something quieter and more corrosive. The slow, accumulating suspicion that you have made an error in judgment, and that the error is not in your analysis but in yourself. This is the third invisible disorder, and it is the one that destroys more sophisticated investors than the other two combined. The confusion of price and value is correctable with a framework. The physiological corruption of analysis by fear is manageable with preparation. But the long, quiet, grinding doubt that emerges when you are doing everything right, and the market is not rewarding you for it, that is something different. That lives in a deeper place. It does not announce itself with adrenaline. It arrives in whispers, in the half-formed questions that surface at 2 in the morning when the rest of the mind is finally quiet. What if I am wrong? Not wrong in the way that an error in a spreadsheet is wrong. Discoverable, correctable, finite. Wrong in the more fundamental way, wrong in my judgment, wrong in my reading of the company, wrong in my assessment of my own capacity to evaluate something that professional analysts, with more resources and more experience and more access, have presumably already evaluated and priced accordingly. This is the question that Graham never quite answered to Marcus's satisfaction in the early chapters, because it is not a question that yields to a formula. It is a question about the relationship between your own judgment and the market's judgment, and that relationship is not symmetric, and it is not static. The market is not merely a collection of other people who might be wrong. It is a collective intelligence with real information embedded in it, aggregated across millions of transactions by participants who have, in many cases, more knowledge about specific companies than any individual investor operating independently can hope to accumulate. The market is often wrong. It is not always wrong, and distinguishing between the times it is wrong in a way you can exploit and the times it is right in a way you need to respect is the central difficulty of the entire enterprise. Marcus added shares. This was the decision that, in retrospect, would define the chapter of his education he was entering. Not dramatically. He did not double the position, did not commit capital he could not afford to hold for years, did not make a bet in the speculative sense. He bought more shares of the technology company at $53, a price that his valuation said was still well below the range he had estimated, at a margin of safety he calculated as adequate. He acted from his framework. He acted from his analysis. He acted, as Graham would have counseled, from his own estimate of value rather than from the market's current opinion of it. And then the company reported earnings that came in below his projections. Not dramatically below. Not the kind of miss that signals structural deterioration, management failure, a competitive threat that had materialized faster than anticipated. Revenue had grown, but at a rate 3 points below the midpoint of what he had modeled. Operating margins had compressed slightly, in a way that could represent a one-quarter anomaly or the beginning of a trend. The stock dropped another 9% on the earnings release, and Marcus sat with his coffee and his open laptop and read the transcript of the earnings call 3 times. The first reading was for information. The second reading was for nuance. The third reading was for honesty. The specific kind of honesty that requires you to ask not whether the information supports your existing thesis, but whether the information would cause you to build a different thesis if you were starting fresh. He did not know. That was the honest answer. And it was an uncomfortable one, because he had built a self-image as someone who could do this analysis, who had the temperament Graham described, who had progressed from speculator to investor through the discipline of exactly this kind of careful reading. The not knowing felt like evidence that he had overstated his own competence. Graham had warned about this moment, not in those terms, but the warning was there, embedded in a passage Marcus had underlined but not fully absorbed. The investor, who cannot distinguish between a temporary setback and a permanent impairment of value, is not yet equipped to practice the discipline he is attempting. The ability to make that distinction is not conferred by reading about it. It is developed through the repeated, uncomfortable experience of being in the position and being required to decide. The position required him to decide now. He made a list. Not a list of reasons to hold and reasons to sell, which is the kind of list that tends to reflect the conclusion you have already reached rather than the analysis you need to perform. He made a list of the specific assumptions in his original valuation, and whether each one had been confirmed, challenged, or invalidated by the earnings report. Revenue growth assumption. Challenged. Not invalidated. The company was still growing, at a rate that fell below his projection, but remained above the industry average. Margin assumption. Uncertain. A single quarter of compression was insufficient to distinguish trend from noise. Competitive moat. Unchanged. No evidence in the earnings call, or the subsequent analyst commentary, that a competitor had meaningfully disrupted the core product. Management quality. A legitimate question. The miss had not been adequately explained in the call. The CFO's language had been vaguer than in previous quarters, in a way that could be protective caution or something less benign. The conclusion of the list was not definitive. It was a probability statement. The thesis was more likely still intact than not, but the margin of that likelihood had narrowed. And the narrowing was real, and should be acknowledged, rather than explained away. This is the specific discipline that separates the investor from both the speculator and the dogmatist. The speculator abandons the thesis when the price falls, because the price falling is his signal that something is wrong. The dogmatist holds the thesis regardless of what the evidence says, because changing the thesis feels like admitting defeat. The investor revises the thesis when the evidence warrants revision, holds it when the evidence does not, and has the self-knowledge to distinguish between evidence and discomfort. Marcus held, not because holding was comfortable. It was not comfortable at all. He held because his list of assumptions indicated that the evidence, as of this earnings report, did not warrant revision of the core thesis, and because the discomfort of holding a position the market was punishing was not, by itself, evidence of anything except that he was human and that being human was, in this particular context, an occupational hazard. What he had not anticipated was how the holding would feel over time. Not the acute discomfort of the drop or the earnings miss, but the chronic, low-level friction of watching a position underperform for months, while people he respected in the investment community expressed views that contradicted his own. He had found a forum where serious, analytically minded investors discussed specific companies, and several of the participants whose work he had come to respect had concluded, based on the same earnings data he had, that the margin compression was not a one-quarter anomaly, but the early signal of a structural shift in the company's pricing power. Their analysis was careful. Their reasoning was not irrational. They had identified a dynamic in the competitive landscape that Marcus had noted and evaluated as non-threatening, and they had evaluated the same dynamic and concluded that it was more significant than he had. Neither conclusion was demonstrably wrong given the available information. They were two different readings of an uncertain situation, both arrived at through legitimate analytical processes. This is the most destabilizing discovery an investor can make. That diligent analysis, applied honestly to the same facts, can produce genuinely different conclusions, and that there is no immediate mechanism for determining which conclusion is correct. The market will eventually reveal the truth. The weighing machine will eventually render its verdict. But in the meantime, the investor must hold a position under conditions of genuine uncertainty, knowing that a thoughtful, well-informed person looking at the same evidence has reached the opposite conclusion. Graham had a response to this, and it was characteristically precise. The question, he argued, was not whether you were right and the market was wrong. The question was whether your analysis was based on defensible reasoning applied to accurate information. If it was, and if your margin of safety was adequate, then the uncertainty was not a problem to be solved, but a condition to be endured. The margin of safety existed precisely because your analysis might be wrong. If your analysis were always right, you would not need a margin of safety. You would simply need to be correct. But enduring uncertainty is not a passive activity. It requires the continuous, active work of distinguishing between new evidence that should update your thesis and noise that should not. Every earnings release, every analyst report, every industry article was a potential input, and the discipline of deciding which inputs to weight and which to discount was a discipline that no formula could replace. It required judgment, and judgment required being honest about the limits of your judgment, which required a kind of epistemic humility that was in direct tension with the confidence required to hold a contrarian position for an extended period. Marcus was discovering that the virtues required of an investor were not merely additive. They were sometimes in tension with each other. Conviction and humility, patience and vigilance, the willingness to hold against the market's consensus, and the willingness to revise when the evidence genuinely demanded it. The investor who resolved these tensions too quickly in either direction, either by defaulting to conviction and ignoring contradicting evidence, or by defaulting to humility and abandoning defensible positions whenever they became uncomfortable, would fail in different but equally predictable ways. He thought about Graham in 1929. Not the Graham who had already written the books, the established figure whose wisdom had been confirmed by decades of subsequent evidence, but the Graham who had watched his portfolio lose most of its value in a market that showed no signs of stabilizing, who had made commitments to partners and family that the declining values were making increasingly difficult to honor, who had written about rationality and value and the primacy of analysis over emotion, while experiencing the full weight of what it meant to be wrong in a way that had real consequences for real people he cared about. That Graham had not stopped believing in the framework. He had been tested by exactly the conditions that could reasonably have destroyed the framework, and he had held. Not because he was incapable of doubt, because the doubt, when examined carefully, did not produce a better alternative. The framework might be wrong, but abandoning the framework in favor of what? Following the market's mood? That had demonstrably failed him before he had developed the framework, and it was demonstrably failing the people around him who had never developed it. The framework was imperfect. The alternatives were worse. This is a different kind of conviction than the conviction that you are right. It is the conviction that your method is sound, even when it is not producing the results you expected, even when the evidence is ambiguous, even when thoughtful people disagree with you. It is harder to sustain because it requires holding two things simultaneously: the genuine possibility that you are wrong, and the genuine belief that your framework gives you the best available tool for finding out. There is a concept that practitioners of behavioral finance call loss aversion, and it is more precisely observed than it is usually described. The standard formulation is that losses feel twice as painful as equivalent gains feel pleasurable, and this is approximately true as a description of average human experience, but it misses something important about how the phenomenon actually operates in investment contexts. It is not primarily that the loss is more painful. It is that the loss arrives in a social context that the gain does not. When your position declines and the market is rising, you are not merely experiencing a financial loss. You are experiencing a social divergence from the consensus, and social divergence has evolutionary costs that your nervous system is very old and very certain about. The person who is wrong when everyone else is right is not merely wrong. In the environment for which the human nervous system was designed, being the outlier in a group assessment of risk was frequently fatal. The group knew something you did not. Their consensus was evidence of reality. To deviate from it was to expose yourself to whatever the group was collectively avoiding. This calculus, which was reasonable in the Pleistocene, is systematically counterproductive in a financial market where the consensus opinion of the group is the primary driver of mispricing, and where the correct position is frequently the one that differs from the group's current view. Marcus felt this on a cellular level during the months the portfolio underperformed. It was not the financial loss alone, though the financial component was real and uncomfortable. It was the combination of the financial loss and the social isolation of being wrong while others were right, of holding a position that the market was punishing, of defending a thesis to himself and occasionally to others in contexts where the defending felt increasingly like rationalization. The discomfort was not evidence of error. It was evidence of humanity. But humanity, in this context, was the enemy of the framework, and the framework was the only protection he had. Graham understood this, and his response to it was not to counsel the elimination of the social instinct, which would be as futile as counseling the elimination of the fear response. His response was to insist on the primacy of the written record. Keep a written record of your thesis before you enter a position. Write down the assumptions, the valuation, the specific conditions under which you would revise or exit. Then, when the position goes against you and the social pressure to conform mounts, read what you wrote. Not to be bound by it. If the facts have changed, the thesis should change. But to distinguish between a thesis that has been invalidated by new facts and a thesis that is merely uncomfortable because the market has rendered a temporary negative judgment. The written record is the objective correlative of your pre-pressure judgment. It is what you thought when you were thinking clearly, before the adrenaline and the social isolation and the financial discomfort had compromised your analytical capacity. Reading it does not guarantee that you were right. It guarantees that you can evaluate the current situation against your prior reasoning rather than against your current feelings, which is a different and much more reliable standard. Marcus had not kept a written record. He had kept a spreadsheet, but a spreadsheet is not a thesis. A spreadsheet records what the price did. A thesis records what you believed and why you believed it and what would cause you to change your mind. The difference between those two documents is the difference between a diary of the weather and a theory of climate. Both involve the same phenomena. Only one has the analytical structure necessary to make the data meaningful. He began writing theses. 1 page each, no more. The company, the thesis, the key assumptions, the valuation range, the conditions for revision, the conditions for exit. He wrote them before he entered positions, and he read them before he evaluated positions under pressure. It was a small practice. It took 20 minutes per position. It was, over time, the single most useful thing he did, not because the theses were always right. Several were wrong, one spectacularly so, a company he had analyzed carefully and valued confidently, that turned out to have management practices that his analysis had not detected, and that the market eventually priced in a way that was, on reflection, accurate. He sold that position at a loss. The loss was real. But the written thesis made it possible to sell for the right reason, because the facts had changed in a way that invalidated the analysis, not because the price had fallen in a way that scared him. The distinction between those two reasons for selling is the entire difference between investment and speculation enacted in a single transaction. The technology company released its next quarterly report 6 months after the earnings miss. Revenue growth had reaccelerated. Operating margins had expanded back above the level Marcus had originally projected, and the CFO's language in the earnings call was specific and confident, in a way that distinguished it clearly from the vagueness of the previous quarter. The stock moved up 14% in the session following the announcement. Marcus did not feel vindicated. That was the part he had not expected. He had imagined, during the months of grinding uncertainty, that the confirmation of his thesis would feel like relief, like the resolution of a tension that had been present for too long. What he felt instead was something quieter. A recognition that the process had worked, that the framework had held, that the patience and the analysis and the uncomfortable maintenance of a position through disagreement had produced the outcome the framework predicted it would produce, given that the original thesis had been correct. But he also knew, and this was perhaps the most important thing he had learned, that the same process applied with the same discipline to a thesis that turned out to be wrong would have produced a loss. The process did not guarantee the outcome. It only guaranteed that the outcome would be determined by the quality of the analysis rather than by the quality of the emotional management. And over a career, over enough decisions made through the same disciplined process, the quality of the analysis would accumulate into returns that the undisciplined investor could not replicate, even in years when specific decisions went wrong. The framework had a crack in it, and Marcus had found the crack during those months of grinding underperformance. The crack was not in the logic. The logic was sound. The crack was in the implementation, in the space between knowing what the framework required and being able to do it when doing it was hardest. Graham had described the virtues of the intelligent investor: patience, discipline, humility, conviction. He had not fully described the conditions under which those virtues are most difficult to practice, which are precisely the conditions in which they matter most. The crack, named directly, was this: the framework depends on the investor's ability to distinguish between evidence that changes the thesis and discomfort that does not. And that distinction, which is conceptually simple, becomes practically very difficult when the discomfort is intense enough and sustained enough and socially reinforced enough. When every signal in your environment is telling you that you are wrong, the act of correctly reading the evidence requires a clarity of mind that the environment is actively working to prevent. There is no solution to this. Graham did not offer one because there is not one. What there is, instead, is practice, the accumulation of experiences in which you navigated that difficulty and the pattern recognition that develops over time about what genuine evidence of thesis failure looks like versus what social and emotional pressure looks like when it is pretending to be evidence. The written thesis helps. The margin of safety helps. The conscious study of your own error patterns helps. None of it makes the difficulty disappear. All of it makes you marginally more capable of navigating it correctly, and marginality, accumulated over enough decisions and enough years, is the difference between the intelligent investor and everyone else. Graham had written, in a passage Marcus had not underlined the first time he read it, and had been unable to stop thinking about since: the investor cannot enter the market and expect to find it rational, consistent, or responsive to his needs. He can only enter with a set of principles that are rational and consistent in themselves, and trust that the market, over time, will do what it has always done: return price to value, punish the undisciplined, and reward the patient. Not always. Not on any predictable schedule. Not in ways that would be comfortable or satisfying in the short run. But over time, with the weighing machine moving in the dark, pulling and pulling against the noise of the voting, returning price to value with the patient inevitability of a tide that knows exactly what the moon has asked of it. Marcus closed the transcript. He made coffee. He stood at the window. The neighborhood was the same neighborhood. The dog with the too large leash had been replaced by a different dog, also too large for its leash, walked by a different person. The children on the corner were different children, or possibly the same children at a different time of morning. He could not be certain. The world outside the screen remained indifferent to the screen, and the screen remained a window onto something that was neither true nor false, but was only the current temperature of human expectation, as unreliable and as inevitable as weather. The difference now was that he knew which machine he was watching. He had learned to hear the difference between ums of the vote and the slow, inaudible movement of the scale. And the knowing, while it did not make the uncertainty comfortable, made it workable. Made it something a person could carry without being crushed by it. That, he was beginning to understand, was the real margin of safety. Not the gap between the price and the value. The gap between what the market demanded of his emotions and what his framework asked of his judgment. If you could hold that gap open, if you could prevent the emotional weather from collapsing into the emotional apse of the analytical structure, then the structure would do what structures are built to do, bear the weight that would otherwise bear down on you. He updated his valuation with the new data. The range had shifted upward, between $88 and $107 per share, incorporating the actual performance of the past 2 quarters and revised forward assumptions. The stock was trading at 81. Still below the bottom of the range, still inside the margin of safety, though the margin had contracted substantially from the levels at which he had bought. He held because the framework still said hold, and because one of the things he was building, slowly, was the habit of following the framework consistently, rather than only when it was convenient. This is the part of the education that no book can fully deliver, and that only time can confer. The knowledge, accumulated through repeated experience, that the framework works over the long run, even when it does not work in any given quarter. That the individual decision correctly made produces the wrong outcome often enough that individual outcomes cannot serve as feedback on individual decisions. That the only meaningful feedback is the pattern across enough decisions and enough time, and that patience with the pattern requires a faith in the method that precedes any specific evidence and must survive the periods when the specific evidence is most discouraging. This is not blind faith. It is the informed trust of someone who has examined the method under pressure and watched it hold. Chapter 4. The Sound Investor, or what it actually looks like when the framework begins to work. The reorganization does not begin with a decision. It begins with a different quality of attention. Marcus noticed it first, on a Sunday morning in early spring, sitting at his desk with the spreadsheet open in one window, and the annual report of a company he had been studying for 3 weeks open in another, and realizing that the 2 documents felt, for the first time, like they belonged to different activities. The spreadsheet tracked what the market thought. The annual report described what the company was. He had always known this distinction intellectually. He was only now beginning to feel it at the level of practice, which is the only level that matters. He had spent the winter rebuilding. Not dramatically. There was no single moment of resolution, no clean before and after. What there had been was a steady accumulation of small corrections, each one almost invisible in isolation, that had collectively shifted the direction of his attention. He had written theses for every position he held, working backward from current holdings to determine whether each one had a genuine analytical foundation or whether it had been bought on the momentum of the voting machine. 2 positions did not survive the exercise. He sold them without drama, at a modest loss in one case and a modest gain in the other, and the selling felt different from the way selling had felt before. Less like a defeat and more like an edit. The concept of editing is worth dwelling on, because it captures something that the investment literature tends to understate. The portfolio is not a monument. It is a working document. It reflects, at any given moment, your best current assessment of where value exceeds price by a sufficient margin, and it should be revised when that assessment changes. When new information alters the thesis, when price appreciation closes the margin of safety, when a better opportunity emerges that makes a current holding relatively less attractive. The investor who cannot edit his portfolio is the investor who has confused commitment with conviction, who has made the psychological error of treating a financial position as a statement about himself rather than a provisional judgment about a business. Graham had a specific caution about this error. He called it the ego investment, and he had watched it destroy otherwise capable analysts. People who had done real work on a thesis, had committed to it publicly or semi-publicly, and then found themselves unable to revise it when the evidence changed, because revising felt like admitting that the original work had been flawed. The ego had entered the position. The analysis had become personal, and personal analysis is the worst kind, because it is no longer trying to find the truth. It is trying to defend a prior version of yourself. Marcus had been guilty of this, and knowing it was the first step toward correcting it. Several of the positions he had held through the difficult months had been held, in part, because selling them would have meant admitting that the original thesis had been incomplete. The incompleteness had not been disqualifying. No thesis is complete, and the margin of safety exists specifically to absorb the incompleteness. But the emotional cost of the admission had been adding invisible weight to the whole decision, and invisible weight is the most dangerous kind. Because you cannot put it on the list had become a practice. Every quarter, he reviewed each position against its written thesis and asked 3 questions. Has the business performed in a way that confirms, challenges, or invalidates the core assumptions? Has the price moved in a way that has materially changed the margin of safety in either direction? Has new information emerged that would cause me to build a different thesis if I were encountering this company for the first time today? The 3 questions were not a formula. They did not produce automatic answers, but they created a structure for the review that was independent of mood, of recent price movement, of whatever the financial media was currently saying about the sector. They forced the question to be about the business rather than about the price. This discipline had a cost, and Marcus was honest with himself about what the cost was. He was slower. He moved through fewer positions than the people in his investment community who were more actively trading. He missed opportunities. There were companies whose prices moved sharply in a short window that he had identified but not yet fully analyzed, and the discipline of not buying what he had not fully analyzed meant watching those opportunities close without him. The discipline had a price, paid in the form of foregone gains on decisions he had not made. Graham had anticipated this objection and had answered it with a specificity that Marcus found both comforting and clarifying. The enterprising investor, he wrote, should not expect to outperform the market in every year, or even in most years. What he should expect, if his method is sound and his discipline is consistent, is to outperform over a full market cycle, a period long enough to include both the euphoric conditions that reward the speculator and the corrective conditions that reveal the inadequacy of speculation as a long-term strategy. The measure of the method is not the best year. It is the worst year, and whether the worst year is navigated in a way that leaves the portfolio positioned to recover. Marcus had now been through a worst year, or something close to it. He had watched the portfolio go sideways while the market climbed. He had held positions through an earnings miss. He had written theses and read them under pressure, and made the sell decision when the evidence demanded it, and the hold decision when it did not. He had been wrong on 2 positions and right on 3, and the rights had substantially outweighed the wrongs in dollar terms because the rights had been bought with margins of safety that absorbed the error in the wrongs. The mathematics of this is one of the most important and least intuitive aspects of the Intelligent Investor framework. If you buy 5 positions, each with an adequate margin of safety, and 2 of them prove to be mistakes and 3 of them prove to be correct, you make money. Not because your analytical batting average is good. It is not. 40% error rate is not a good batting average in any other domain. It is because the margin of safety on the correct positions generates returns that are large enough to absorb the losses on the incorrect ones and still produce net positive results. The framework is not designed to eliminate error. It is designed to make you profitable despite error, which is a completely different and far more achievable objective. He had begun applying the framework to situations that were more complicated than the straightforward undervalued company analysis he had started with. Graham's categories of value opportunity were broader than Marcus had initially appreciated. Not just companies trading below their intrinsic value, but companies in temporary distress whose underlying businesses were structurally sound, companies with hidden assets that the market was not pricing, companies in cyclical industries at the bottom of the cycle whose earnings had temporarily collapsed, but whose earning power over the full cycle was solid. Each category required a different analytical approach, but all of them shared the same fundamental structure. Estimate what the business is worth, compare to what the market is charging. Buy when the gap is sufficient. The distressed company analysis was the one he found most counterintuitive and most revealing. Distressed companies feel wrong to buy. The narrative around them is almost always negative: declining revenues, missed estimates, leadership challenges, competitive threats. The language of failure that the financial media amplifies, because failure is more engaging than the slow accumulation of value. Buying into that narrative requires the specific psychological posture that Graham had described as going against Mr. Market when Mr. Market is most insistent, which is also the moment when doing so is most uncomfortable. Marcus found a company in this category in the late spring, a mid-sized manufacturing business in an industry that had been disrupted by foreign competition, whose revenues had declined for 3 consecutive years, whose stock had fallen 64% from its peak, and whose management had recently initiated a restructuring that the market had greeted with skepticism. The skepticism was rational. Restructurings frequently fail, and this company had announced restructurings before. But the skepticism was also, in Marcus's analysis, already fully priced into the stock. The market had not merely recognized the risk. It had capitalized the risk at a level that implied the company had essentially no recovery value. His analysis suggested otherwise. The core manufacturing operation, stripped of the overhead that the restructuring was eliminating, generated cash flow that was modest but positive, and was likely to remain so under a range of adverse scenarios. The balance sheet was strained but not broken. The debt load was manageable if the cash flows held, and the assets on the balance sheet had a liquidation value that exceeded the current stock price, even under conservative assumptions about what those assets would fetch in a distressed sale. The margin of safety, if his asset analysis was approximately correct, was substantial. He bought a small position. Smaller than his framework would have suggested for a company with a stronger operational history, because the history of unsuccessful restructurings was genuine evidence of risk that his margin of safety needed to be wide enough to absorb. He wrote the thesis. He noted the specific conditions under which he would add to the position and the specific conditions under which he would exit. And then he sat with the discomfort of owning a company that every financial commentator who mentioned it described as a falling knife. Falling knife is one of the financial media's favorite phrases, and it is worth examining what it actually means and what it obscures. The image is of a knife dropped from a table. You should not try to catch it because you will cut yourself. Applied to stocks, it is a caution against buying falling prices on the theory that a falling price has momentum and will continue to fall. The caution is not irrational. Prices do have momentum, and buying a declining stock solely because it has declined is not analysis. But the phrase obscures something important. A knife, once it has landed, is a knife. Its trajectory has reached its natural endpoint. What makes it a knife is not where it came from, but what it is. A business is the same. The trajectory of the price tells you about the voting machine. The nature of the business, its cash flows and its assets and its competitive position, tells you about the weighing machine. The investor's job is to evaluate the knife, not the trajectory. The manufacturing company's restructuring was slower than management had projected, which had been in Marcus's analysis as the base case rather than an upside scenario. The stock continued to decline for 6 months after he bought it. During those 6 months, he reviewed the thesis 4 times against new quarterly data, and each time the review confirmed that the business had not deteriorated below the range his valuation had assumed. The core cash flow was holding. The asset values had not changed. The market's continuing pessimism had not produced new facts that justified it. It had produced lower prices, which meant larger margins of safety for anyone willing to do the analysis. He bought more at a lower price. This is the part of the intelligent investor framework that is, in practice, the hardest to execute. The willingness to increase exposure to a position that has declined when the analysis still supports the thesis and the declining price has improved rather than worsened the investment case. Every instinct argues against it. The loss is real. The additional capital is real. The possibility of continued decline is real. And the social proof of the market's continuing negative verdict is overwhelming. Graham called this the process of averaging down, and he was careful to distinguish it from the speculator's error of throwing good money after bad. The distinction is entirely in the quality of the prior analysis. If the thesis was sound and the new price represents a larger margin of safety, adding capital is rational. If the thesis was unsound and the position is declining for reasons the original analysis missed, adding capital is accelerating the error. Marcus had the thesis. He had written it. He had reviewed it 4 times. He added capital. 12 months after his initial purchase, the manufacturing company announced a quarterly result that was, by any ordinary standard, unimpressive. Flat revenues, modest improvement in margins, no dramatic evidence of recovery. The stock rose 22% in the session following the announcement, not because the result was impressive, because the market had priced in continued deterioration, and flat revenues with improving margins was not deterioration. The weighing machine had not moved. The voting machine had recalibrated. The gap between what the market expected and what the business delivered was not a large gap in absolute terms, but it was a gap in the right direction. And in a stock that had been pricing in disaster, a gap in the right direction was sufficient to produce a substantial price movement. This is the mechanism that Graham had described and that Marcus was now experiencing from the inside. The distressed company at the bottom of its cycle, bought with a sufficient margin of safety, does not need to recover dramatically to produce good returns. It needs to merely be less bad than the market expected. The market had been pricing catastrophe. The company had delivered difficulty. The distance between catastrophe and difficulty was 22% in a single session, and the investor, who had done the analysis and maintained the position through the grinding uncertainty, captured the entire distance. He did not sell, not immediately. The thesis he had written specified conditions for exit, and those conditions had not been met. The price had recovered but was still, by his analysis, below the range of intrinsic value. The restructuring had produced early evidence of success, but had not yet been proven out over enough time to raise the confidence level in the higher end of his valuation range. Selling now would be taking profit from a position that the framework said still had room to run, and taking profit because the price had moved was the voting machine's logic, not the weighing machine's. He held for another year. Then the company was acquired by a larger competitor at a price that represented a premium of 41% to the market price at the time of the announcement. Marcus sold into the acquisition. His combined return on the position, including both tranches of purchases, was 63% over 22 months. The number was not the lesson. The process was the lesson. The analysis before purchase, the written thesis, the 4 reviews under pressure, the decision to add capital at a lower price because the thesis supported it, the decision not to sell when the price recovered because the thesis said more value remained, the exit when the acquisition provided a price that was within the range of intrinsic value the thesis had estimated. Every step of that process had a corresponding emotional counterpart that had argued against it. The analysis before purchase had felt like research on a broken company. The written thesis had felt like committing to something the market was rejecting. The 4 reviews had felt like looking for reasons to abandon a position that was losing. The decision to add capital had felt like escalating a mistake. The decision not to sell at the recovery had felt like greed masquerading as discipline. The exit had felt, in the end, like the only decision that had not required overriding an emotional signal, because the acquisition price made the weighing machine's verdict visible and unambiguous. The framework had won every argument with the emotional counterpart, not by eliminating the emotion, but by providing a structure that the emotion could not invalidate. The fear had been present at every decision point. The framework had been present too, and the framework was more reliable than the fear. Graham had written, in a section that Marcus had now read 4 times, that the intelligent investor's advantage is not intellectual in the way that advantage is usually meant in financial contexts. It is not that he has better information, or superior analytical tools, or access to insights that others do not have. His advantage, such as it is behavioral. He does consistently what the emotional structure of the market makes it consistently difficult for most participants to do. Buy when the case is strongest and the feeling is worst. Hold when the evidence says hold and the feeling says sell. Sell when the analysis has been proven out and not before. The behavioral advantage compounds. Not linearly, not dramatically in any single year, but with the patient accumulation of decisions made correctly under conditions that make correct decisions systematically difficult. There is a specific kind of competence that develops only through the accumulation of decisions made under genuine pressure, and it is distinct from the kind of competence that develops through study. Marcus had studied for 11 years. He had read the books, understood the frameworks at a conceptual level, could discuss margin of safety and intrinsic value, and the distinction between investment and speculation with fluency and accuracy. But the study had not given him the competence that he now felt wrought growing in a different part of himself, the competence of someone who has actually done the thing under real conditions and has the pattern recognition that comes only from that experience. Poured recognition in investing is not the recognition of price patterns, which is the concern of technical analysis, and which Graham addressed with considerable skepticism. It is the recognition of psychological patterns, the specific texture of a decision that is being made from fear, versus the specific texture of a decision that is being made from analysis, the difference between a thesis that is holding under pressure, because it is sound, and a thesis that appears to be holding, because the holder has too much ego invested in it to release it honestly. These patterns are not in any book. Well, they are in the accumulated experience of having felt them and having named them after the fact and having built a practice around recognizing them earlier. Graham had this pattern recognition in abundance, and it showed in his writing, in the way that deep experience always shows. Not in the formulas or the frameworks, which could be taught and memorized, but in the quality of the judgment calls around the edges of the formulas, when to make an exception, and when not to. When the margin of safety that the formula produces is insufficient because some qualitative factor is not being captured. A company that appears to be a value trap is actually a genuine opportunity because the narrative around it is more negative than the underlying economics warrant. These are not algorithmic decisions. They are the decisions of an experienced mind that has been through the situation enough times to recognize what it is faster than the analytical process can formally confirm it. Marcus was building this, one decision at a time, one reviewed thesis at a time, one position held through discomfort, and then exited at the right moment for the right reason. He was building it slowly and imperfectly, as it can only be built. But the building was real, and unlike the spreadsheet, which recorded the prices of things, the building was permanent. It was being laid down in the structure of his judgment in a way that no market movement could erase. He thought about his daughter, who was 11, and had recently begun asking questions about money with the specific directness of someone who has noticed that adults behave strangely around it and wants to understand why. He had tried to explain the framework to her once, using an example about a lemonade stand, and she had listened with the patience of someone who was following along and then said, "So you buy something for less than it is worth and then wait?" He had said yes, approximately. She had said, "What is the hardest part?" He had said, "Knowing what it is worth." She had thought about this and then said, "And the waiting." Both, he had told her, both in their own way are the hardest part. She had moved on to other things with the enviable speed of the 11-year-old mind. But the exchange had stayed with Marcus because it had compressed something that he had spent 2 years learning into 2 sentences that were, for all their simplicity, exactly correct. The knowing and the waiting, the analysis that produces the estimate of value, and the patience that allows the weighing machine to close the gap between price and value without the investor intervening in a way that disrupts the process. Both are required. Neither alone is sufficient. And the combination of the two, practiced consistently over enough time, is the entire substance of what Graham had spent a career trying to teach. Marcus looked at the spreadsheet. It looked different than it had a year ago. Not in its format, which had not changed, but in the quality of what it contained. The positions it tracked had theses behind them. The theses had been reviewed under conditions of real pressure, and had held or had been revised for the right reasons. The numbers in the cells were not just prices. They were the most recent data points in ongoing assessments of ongoing businesses, and the businesses behind the cells had been chosen because the analysis said they were worth more than the market was currently charging by margins sufficient to absorb the errors that the analysis would inevitably contain. He thought about the person he had been 2 years ago, the 11 years of competent improvisation, the spreadsheet calibrated to the voting machine, the self-image built on a 9.3% average that had required more luck and fewer genuine tests than he had acknowledged to himself. That person had not been foolish. He had been unfinished. The finishing had required the drop, the earnings miss, the months of grinding underperformance, the distressed company, the adding of capital when every instinct argued against it, the holding when the price recovered, the exit when the analysis said exit. The reorganization, he understood now, was not of the portfolio. The portfolio was an artifact. The reorganization was of the mind that managed it, the replacement of a reactive, price-following, emotionally driven process with a slower, more deliberate, analysis-grounded one. The mind that had looked at a falling price and felt it as a verdict had been partially replaced by a mind that looked at a falling price and asked whether the thesis still held. Partially, the emotional response had not been eliminated. The framework had been built around it, like a structure built around a fault line, not eliminating the ground's movement, but channeling it in a direction that did not bring the building down. The spring afternoon light was coming through the window at an angle that made the desk look different than usual, warmer, and Marcus sat in it for a moment before closing the laptop. The numbers in the spreadsheet were good, not spectacular. He was not a spectacular investor, had not become one, did not expect to become one. He was a sound investor, which is what Graham had actually argued for, and the distinction mattered. Spectacular implies outlier results in the short run. Sound implies consistent results over the long run. The spectacular investor gets written about. The sound investor builds wealth quietly over time in a way that is immune to the reversal of fortune, that tends to catch the spectacular ones when the conditions that produce their results change. He was building wealth. He was also, and this felt at least as important, building a mind. The kind of mind that could sit with uncertainty without being corrupted by it. That could hold a thesis under pressure without becoming rigid. That could read a falling price as information rather than as verdict. That had learned, through the specific and irreplaceable education of actual experience, to hear the difference between the noise of the vote and the slow, permanent movement of the scale. Chapter 5. The New I, or What Remains When the Market Has Taught You Everything It Can. 3 years after the morning the number appeared on the screen at 9:31, Marcus sold the technology company, not because something had gone wrong, because something had gone right completely. And finally, in a way that closed the chapter the way chapters are supposed to close. Not with drama, but with the quiet satisfaction of a thing that has run its full course. The company had continued executing. Revenue had compounded at the rate his original thesis had projected, then slightly above it. The margins had recovered from the compression of that difficult quarter and had expanded beyond his initial estimates as the competitive dynamics he had analyzed played out largely as he had anticipated. The stock had risen from the $51 at which he had bought additional shares to $119, a price that now exceeded even the upper end of the valuation range he had estimated 3 years ago. When a price exceeds your estimate of intrinsic value, the margin of safety has inverted. You are no longer buying something worth more than you are paying. You are holding something the market is paying more for than it is worth, which means Mr. Market has swung from panic to enthusiasm, and enthusiasm is not a reliable basis for continued appreciation. Graham had been precise about this. The intelligent investor sells when the price has reached his estimate of value, not when the price has reached its peak, because he has no reliable method of identifying the peak, and attempting to do so is speculation. Marcus sold. He did not attempt to identify the peak. He did not wait to see if the enthusiasm would carry the price higher still. He sold at a price that fell within the range of his estimate of intrinsic value, captured the return the framework had predicted was available when he bought, and moved the capital to 3 new positions, where his analysis had found adequate margins of safety waiting for the patient investor. The transaction took 11 minutes. He had written the exit conditions in the original thesis. When the conditions were met, he executed. The decision itself required almost no deliberation, because the deliberation had been done in advance, in the months before the position was opened, when his mind was clear, and the conditions he was evaluating were theoretical rather than emotionally loaded. This is one of the most underappreciated aspects of the written thesis. It does not merely help you make better decisions under pressure. It removes most of the decision-making from the pressured moment entirely, relocating it to the calmer time of analytical preparation. He thought about the morning the drop had happened. He thought about the 11 seconds between seeing the number and deciding what it meant, and how those 11 seconds had compressed into a physiological event, the entire problem that Graham had spent a career trying to help investors solve. He had not solved it that morning. He had been frozen by it, which had accidentally produced the right behavior for the wrong reasons. But the freezing had created enough space for the framework to begin assembling itself. And the framework, once assembled, had changed the quality of every subsequent decision. This is how the education actually works. Not as a linear progression from ignorance to knowledge, but as a spiral. You encounter the problem, you are inadequate to it, you acquire the tools. You encounter the problem again under different conditions. You are more adequate to it than before, but still imperfect. You acquire more tools. The problem recurs in a new form. The spiral does not terminate. What changes is the quality of your response at each encounter, and the quality of the response is the only measure of the education that matters. Graham had spiraled through this his entire career. The books he wrote were not the books of someone who had arrived at a destination. They were the books of someone who had been around the spiral enough times that the pattern had become clear, and who wanted to give the people behind him on the spiral enough information to make each circuit faster and less costly than his own had been. He did not succeed perfectly. The books are dense and demanding, and many people who buy them receive the information without the preparation that would allow it to penetrate. But for the person who arrives at the books having already been through enough of the spiral to recognize what they are describing, the information lands differently. It lands as recognition rather than instruction. Marcus had arrived at Graham that way. Through the drop, through the earnings miss, through the grinding months of underperformance that had prepared him to understand what he had previously only memorized. The preparation had been expensive. It had cost him returns he would not have lost if he had been operating from the framework earlier, and it had cost him several years of anxiety about his own competence that a clearer understanding of what he was doing would have prevented. But he had arrived, and the arriving had changed not just his investment results, but his relationship to uncertainty itself, which turned out to be a much larger gift than the returns. The relationship to uncertainty is the thing that the investment literature rarely discusses directly, because it is not quantifiable, and the investment literature prefers what is quantifiable. But every serious practitioner understands it, and it is the thing that separates the investor who endures from the investor who eventually capitulates. Uncertainty is not a temporary condition that the right information will eliminate. It is the permanent condition of every forward-looking judgment about any complex system. The market will always be uncertain. The future of any business will always be uncertain. The analyst who requires certainty before acting will never act because certainty is not available. The analyst who acts without acknowledging uncertainty is operating on false confidence that the market will eventually correct at his expense. The intelligent investor has a different relationship to uncertainty than either of these. He acknowledges it fully. He builds his margin of safety, specifically, because he knows his estimate of value is uncertain and could be wrong. And then he acts anyway, because the acknowledged uncertainty, combined with a sufficient margin of safety, produces a situation in which he can afford to be wrong within a range and still produce acceptable outcomes. He is not certain. He is calibrated. The difference between those two states is the entire difference between the speculator who bets on being right and the investor who structures his decisions to survive being wrong, Marcus had become calibrated. Not perfectly. Calibration is a practice, not a destination, and his estimates of intrinsic value continued to contain errors that he discovered in retrospect and worked to understand. But the errors were now systematically analyzed rather than defensively rationalized. When a thesis proved wrong, he wrote a post-mortem. What had his analysis assumed? What had reality delivered? Where had the gap been? And what adjustment to his analytical process would narrow the gap in future? The post-mortem was not a punishment. It was the only reliable mechanism for converting experience into learning, for making the spiral productive rather than merely repetitive. He had, over 3 years, accumulated a small collection of post-mortems. Reading them together produced a pattern. His errors clustered around 2 specific failure modes. The first was the overestimation of management quality, a tendency to read competence into leaders whose communication was fluent and confident, without adequately weighting the evidence of their actual decision history. Fluency is not competence. Confidence is not track record. He had bought several companies whose leaders had impressed him in earnings calls and disappointed him in the subsequent financial results, and the pattern was consistent enough that it had produced a specific corrective in his analytical process. More weight on the historical decision record, less weight on the current communication quality. The second failure mode was more subtle and took longer to identify. A tendency to underestimate the durability of competitive threats in industries undergoing technological disruption. He had several times analyzed the competitive moat of a company as deep and durable, had been right about the depth, and had been wrong about the durability because the technology disrupting the industry had moved faster than his projection had assumed. The correction here was not a simple analytical adjustment. It was a deeper acknowledgement of the limits of his forecasting ability in high-velocity technological environments, which had led him to require wider margins of safety in those industries, or to avoid them in favor of industries where the competitive dynamics were slower and more legible to his particular analytical strengths. This is one of the things Graham had described as the advantage of the individual investor that is rarely claimed and almost never fully exploited: the ability to do nothing. The institutional investor, managing money for clients who expect activity, operates under structural pressure to transact. The individual investor, managing his own capital, can simply decline to act when the opportunity set does not meet his criteria. He can look at the market on any given day and conclude that nothing available at current prices meets the margin of safety he requires, and he can sit in cash and wait. This is not a failure of analysis. It is the successful application of analysis to a situation where the correct answer is, not yet. Marcus had learned to sit in cash. This had been harder than it sounds, because cash feels like waste, feels like the portfolio is not working, feels like the analytical capacity he had built is going unused. The financial media reinforces this feeling constantly. There is always something happening, always a sector that is moving, always a compelling narrative about why now is the time to be in this or out of that. The noise is unceasing, and the noise is specifically designed to make inactivity feel like negligence because the financial media is structurally dependent on transactions, and transactions require the belief that something should always be happening. Graham had a word for the investor who acted in order to feel like he was doing something. He called him active in the wrong way. Not active in the sense of energetic analysis and careful portfolio management. Active in the sense of transacting when the analysis did not support transaction, of being in the market, because the alternative felt passive, of confusing motion with progress in a domain where the most productive thing is sometimes to do nothing at all. Sitting in cash for 4 months in the second year of his rebuilt practice had felt like exactly this kind of wrong activity avoided. The market had been expensive by every measure he applied, price-to-earnings ratios that were historically elevated, margins of safety on the businesses he followed that were thin or absent, a general level of enthusiasm in the financial commentary that reminded him of the conditions Graham had described as most dangerous. He had found one opportunity that met his criteria, a small position he had opened with careful sizing and had held the rest in cash while the market continued to rise around him. The market had risen 14% that year. His portfolio had returned 4%. And then the following year, when the conditions that had produced the elevated valuations had partially reversed, he had deployed the cash into 3 positions that each met his criteria with comfortable margins, and the subsequent returns on those positions had been substantially better than the market. Over the 2-year period combined, his results were ahead. The investor, who had sat in cash during the expensive year, had captured the opportunity the correction created, while the investor, who had been fully deployed throughout, had ridden the market up and then ridden it back down and ended in approximately the same place. This is the temporal dimension of the framework that Graham had described as the most important and the least practiced, the willingness to accept short-term underperformance in exchange for the ability to act decisively when the conditions are genuinely favorable. The investor, who must always be fully deployed, cannot take advantage of the market's periodic episodes of extreme pessimism because he has no capital available to deploy when the prices are most attractive. The investor, who is willing to hold cash when the opportunity set is poor, always has the capacity to act when the opportunity set is rich. The capacity to act at the right moment is the compounding advantage, and it requires the willingness to look wrong in the moments before the right moment arrives. Marcus was 41 now. He had been actively investing for 13 years. The last 3 of them had been different in kind from the first 10, not because his returns had been dramatically higher, though they had been modestly better, but because the quality of his engagement with the activity had changed. He was no longer improvising. He was no longer calibrating his emotional state to the voting machine. He was no longer deriving his sense of competence from the movement of a number on a screen that had no reliable relationship to his actual analytical quality. He was doing something quieter and more durable. He was building a practice, a set of disciplines that were internally consistent, that had been tested under real conditions, and had held, that generated results over time, which were the product of the quality of his analysis, rather than the quality of his luck. The practice was imperfect. It would continue to be refined by the errors it inevitably produced and by the pattern recognition that accumulated from analyzing those errors honestly. But it was his, in a way that the previous 11 years had not quite been. Built by him, tested by him, understood by him at the level of practice rather than merely at the level of principle, Graham had written, in what Marcus now considered the most important single passage in the book, that the investor who permits himself to be stampeded or unduly worried by unjustified market declines in his holdings is perversely transforming his basic advantage into a basic disadvantage. The basic advantage of the individual investor is time. The ability to hold a correct position long enough for the weighing machine to close the gap between price and value. The market cannot stampede a person who has done the analysis, written the thesis, built the margin of safety, and genuinely understands what he owns. It can only stampede the person who has substituted the market's opinion for his own. The person who has his own opinion, grounded in genuine analysis, experiences the market's movements as noise in a signal he is already reading from a different and more reliable source. He read that passage again on the morning he sold the technology company, sitting at the same desk where he had watched the 17% drop 3 years before. The desk had not changed. The neighborhood through the window had not changed. The light came in at the same angle. The coffee was the same temperature, or close enough. What had changed was the person sitting at the desk, and the change had been made entirely by the education, and the education had been made entirely by the willingness to be taught by what the market had shown him rather than did to ease against it. The sold position cleared in 2 days. He moved the capital. He updated the spreadsheet. He wrote 3 new theses for the positions he had identified as his next opportunities. Businesses he had been following for months, whose prices had not yet reached the levels his analysis required, but which he expected would, eventually, when Mr. Market's mood shifted in their direction. He closed the laptop and made coffee. Outside, the neighborhood was the same neighborhood, indifferent, ordinary, proceeding at its own pace through the middle of a Thursday morning. while the market conducted its daily conversation about prices, and the weighing machine continued its patient, invisible work of pulling price back toward value. The dog with the too large leash was a different dog again, walked by a person he had never seen before, going somewhere he would never know. He thought about Graham, dead 46 years, who had sat with the same knowledge in rooms that looked nothing like this one, and had arrived at the same conclusion, that the market is not your enemy, that it is not your oracle, that it is not even your partner in any meaningful sense. It is a mechanism. A machine for producing prices operated by human beings whose emotional responses to uncertainty create, reliably and recurrently, the conditions under which patient analysis becomes profitable. Machine is not going to change. The human beings are not going to change. Fear and greed and the social dynamics of collective opinion have been with markets as long as markets have existed, and they will be with markets as long as markets continue. What can change is the individual investor's relationship to the machine. Not to eliminate the emotional response, which is impossible and undesirable, because emotion is also information, but to have, alongside the emotional response, a framework that is more reliable than the emotion, that has been tested and held, that can bear the weight of a decision that the emotion is temporarily too compromised to make well. That framework is available to anyone willing to do the work of building it, and the work is not primarily intellectual. It is psychological. It is the work of knowing yourself well enough to know when your judgment is operating clearly, and when it is being corrupted by the specific conditions the market creates. Graham had done this work and had written the results down with a precision and care that had survived 7 decades of market evolution without requiring fundamental revision, because the market has changed in every superficial way and in no essential way. The instruments are different. The speed is different. The information available is different. The human beings operating the voting machine are the same human beings they have always been, with the same fears and the same hopes and the same neurological responses to the sight of a falling number on a screen. Marcus sat with his coffee and looked at nothing in particular, and felt, without trying to articulate it, the specific quality of the thing he had built. It was not wealth, though the wealth was there and was growing. It was not competence, though the competence was there and was deepening. It was something underneath both of those, a settled relationship to his own judgment, to the limits of his knowledge, to the permanent uncertainty of every forward-looking decision, to the market as a mechanism he understood rather than a verdict he feared. Graham had called this the intelligent investor's most important asset, and he had not meant the balance in the brokerage account. He had meant the internal architecture, the framework, the discipline, the tested and refined capacity to act rationally under conditions that make rational action systematically difficult. This was the asset that compounded with the most interesting returns. The money compounded at a rate. The internal architecture compounded in a way that had no ceiling, because every year of practice produced a slightly more capable practitioner, and a slightly more capable practitioner made slightly better decisions, and slightly better decisions compounded over a career, were the difference between the investor who built something durable and the investor who merely participated in the market's general direction. There is something Graham never named, but that his entire body of work circles: the relationship between an investor and time. Not time in the sense of investment horizon, though that is part of it. Time in the deeper sense, the willingness to let a process unfold at the pace the process requires, without compressing it, without forcing it, without substituting urgency for patience, because the urgency feels more like action. The market has its own schedule. The weighing machine moves when it moves. The business compounds when it compounds. The investor who has built the right framework and made the right purchase and written the right thesis has done his work. What remains is to wait, and waiting is not the absence of work. It is the final discipline, the one that requires more of the practitioner than any of the analytical tasks that preceded it, because the analytical tasks have visible outputs that feel like progress, and waiting has none. Marcus understood this now in a way he had not understood it 2 years ago, and the understanding had changed the texture of his days. He checked the portfolio less frequently. Not because he had grown indifferent to the results. He had not. Because he had separated the activity of monitoring from the activity of deciding. And he had learned that most of what the daily price movement offered was noise he did not need, sensation without signal, the voting machine's continuous opinion of things whose value changed at a rate the daily price could not accurately represent. He checked when there was a reason to check: an earnings release, a significant piece of industry news, the quarterly review against the written thesis. Between those events, the portfolio did what it did, and his attention was better deployed elsewhere. Elsewhere, in practice, meant the ongoing work of analysis. The companies he was following, but had not yet bought. The industries he was studying to understand whether his analytical methods applied cleanly or required adjustment, the post-mortems from past errors that continued to yield refinements in his process as he returned to them with the perspective that additional experience provided. The work was never finished. Graham had not finished it. Every serious practitioner of the discipline had not finished it. The market was too complex and too dynamic to admit of a finished understanding, and the investor who believed he had finished understanding it was the investor who had stopped learning, which was the investor who had begun. Invisibly. To deteriorate, he thought sometimes about the person who had owned the book before him, the inconsistent underlinings, the initial engagement and then the gap and then the return. He had constructed a story about that person that he knew was probably wrong in its specifics, but that felt true in its shape. Someone who had encountered the ideas before the experience that would make them penetrate, had stored them at the surface level, where ideas go when they are understood but not yet needed, and had returned to them. When the market had provided the education that made the understanding possible, he hoped that person had found the ground. He hoped that person had been through the drop and the grinding months and the distressed company, and had come out the other side with the framework intact and the temperament tested, and the relationship to uncertainty settled into something workable. He would never know. But the book had found its way to the used bookstore, and from there to Marcus for $4, and Marcus had found his way to the ground through exactly the path the book's original owner might have traveled. Was something, and there was something in that chain of transmission that felt like the right way for this kind of knowledge to move. From one person who had been through it to another, through the medium of honest writing that did not oversimplify the difficulty or pretend the education was painless. Graham had been through it. He had written it down. Marcus had been through it. Someday, in some form he could not yet predict, he might find a way to pass it on. Not as instruction. The instruction was already written, and Graham had written it better than he could, but as testimony, as the specific and unreproducible evidence of one person who had stood in the 11 seconds between seeing the number and deciding what it meant, and who had built, over years of error and correction and discipline and patience, a mind that could answer that question from something other than fear. He finished the coffee. He rinsed the cup. He went back to the desk and opened the theses he had been writing, and the work was quiet and absorbing in the way that work becomes when it is genuinely yours. Not performed, not reactive, not calibrated to any audience, not dependent on any external validation. Just the work and the quality of the attention it required, and the slow, patient building of the thing that the work was building. The number on the screen was just a number. The business behind it was a business. The gap between them was either an opportunity or a warning. And the only way to know which was to do the analysis, which he was doing, which he would continue to do, for as long as the weighing machine kept running in the dark, and Mr. Market kept arriving each morning with his new mood and his new offer, indifferent to whether you had prepared for him or not, generous only to the investor who had.